In this video, we're going to deal with this idea of inventory shrinkage. And what is inventory shrinkage? It is when the actual inventory in the store is not the same as, or is less actually, than the inventory in the accounting system. Remember, we use the perpetual accounting system. So as you make sales and purchases throughout the period, your inventory adjusts automatically. So if you buy more stuff, inventory increases. Every time you sell something, inventory decreases. So theoretically, the inventory in the system should be equal to the inventory on the floor. But if you've worked in retail, you know that that's not always the case. People steal things, things get lost, things get dropped. I mean, lots of things happen. So there's usually a discrepancy between the inventory in the system and the inventory that you have. And so inventory shrinkage, which can be very, very expensive, is when the inventory on hand or the inventory in the store is less than the inventory in the system. And so whenever we do that, we have what is called an inventory shrinkage adjustment, where we debit cost of goods sold and we credit merchandise inventory. We credit inventory because the inventory in our system should match the inventory that we actually have. So if there's shrinkage, we actually got to credit inventory for the amount of the shrinkage and debit cost of goods sold. So this is a scenario where whenever there's shrinkage due to theft, loss, damage, etc., then this creates more cost for, or increases the cost to the business, right, without giving it any revenue for selling that inventory. So whenever inventory gets lost or stolen, that's inventory that was never allowed to be sold to generate revenue. Right? You still have to pay your vendor the cost. So if you buy something from me and it gets stolen, well, I don't care whether it gets stolen, you still have to pay me, right? You never got a chance to sell that inventory, so you never made any money for it, but you still had to pay for it. All right, so let's pick up on the last example that we had here, right? So let's just do with the cash sale. We'll just pick up and add this last piece. So on January 31st, an inventory count shows $2,400.50 for inventory on hand for ABC Company. So we're not going to do it for XYZ Company, we're going to do it for ABC Company. So let's take a look at ABC Company. So ABC Company, right, inventory now is $2,500. So our accounting system shows us $2,500 in inventory, but when we did the count, it was only $2,450, right? So that means there's $50 in inventory that we're missing. So how do we fix that? Well, we need to decrease inventory so that it's not $2,500 anymore, it's $2,450. So we're going to credit inventory to bring it down, and then we debit cost of goods sold. So anytime you have shrinkage, right, you debit cost of goods sold, meaning you incur an expense and you reduce your inventory to match exactly what you have on hand. So you'll see the entry here, debit cost of goods sold for 50, credit inventory for 50. So I'm going to go over here, I'm going to credit inventory for 50, and I'm going to go down to cost of goods sold, and debit cost of goods sold for 50. And the date is usually at the end of the period. So this is 131, and this here will be 131, and that's it. Okay? So for shrinkage, and it's not going to be applicable because we didn't do one for XYZ Company. But we could have done our inventory for XYZ Company and done the same thing. So for inventory shrinkage, we do an inventory count that tells us exactly the amount of inventory we have on hand, and if it's less than the actual inventory that we have, then we go ahead and adjust our inventory to equal that. So we debit cost of goods sold for the amount, and we credit inventory for that amount, okay? And then we post it to the ledger, and that's it.